morning or good afternoon to everybody on the call here. Today, actually, let's just back up and just go, man, yesterday the Fed increased interest rates by increased the Fed funds rate by 3/4 of a point. And they're kind of on track here to really kind of push us into they're willing to tolerate a recession is kind of the words that they use. But if we're not in a recession right now, we're probably going to be going into a recession. The Fed is still signaling kind of signs that we're moving forward with more increases through the end of the year, tightening the strings and trying to get inflation under control. Bank of England increased 50 basis points. Switzerland increased 75 basis points. Turkey raised 100 basis points, all to kind of get control of inflation. And, here we've got jobs, job claims, our jobless claims are increasing, but we're full employment. And yet interest rates on the mortgage side are like going crazy, out of control at this point in time. And the market really does not have confidence in the Fed and what they're doing to solve this issue of inflation. But today, what we're going to talk about is kind of the value versus worth of properties. And so what is going on in this changing market, and what's happening to values? Are they staying strong? Is the inventory starting to pick up a little bit? Is that having an impact? Are the buyers sitting on the sidelines? All these things we have questions about as far as kind of what's going on. In fact, I even have a house that's listed at this point in time trying to sell it, and we're not getting very many bites on it at this point in time. And so is it priced too high? Is it just because of the interest rates that have gone up? What are all these factors that have an impact on properties that are selling? So today, what we're going to do is it's a little kind of a group here of 50 people or so. And so we're going to be a little bit relaxed here. If you have a question, raise your hand using the Zoom tools, and basically we'll call on you, and basically to answer that, you can ask your question and we'll give you an answer, or we'll give somebody from the team will give an answer to your question. And then we'll also have a Q&A at the end of the presentation as well. So we've got a team from AXIS Appraisal Management. And so if you go to the next slide here. So AXIS is one of our partners in our business, and we order all of our appraisals through AXIS, and they're the ones that set up the appointments with the appraisers, all the real estate agents, and so forth. And we've actually just last week set up an agreement with them to really get the appraisals done in certain markets. So like Los Angeles, Ventura County, San Diego County, really to get appraisals turned in a 5-day turn time process right now. So we have a nice agreement with them. But what we have today is a team from AXIS, and I'm going to hand it over to them. They're going to go through some of the, they're going to introduce themselves, and then we'll go through some of the questions and answers that we already have planned. So guys from AXIS, go ahead and take it over.
Hey, thank you, Mike. My name is Mark Ayton, and I'll just give a quick overview of our presentation and introduce you briefly to our heavy hitters and let them talk to you a little bit more about themselves. But first, I want to thank Mike, Michelle, and Marty for organizing this event. Capstone's always been an excellent partner, and they're among a small set of clients that actively seek opportunities for collaborations and value adds like this. This particular promoting of a forum for communication will hopefully present a forum where we see two-way communication. Not only are we helping you understand and answer some questions that you have within the market, but the feedback that you give us, we can take back and hone our services even further. And hopefully you'll be able to take some increases of understanding and service out to your customers and stakeholders. For those of you that are not familiar with AXIS, we were started about 13 years ago by Kim Parati and Michael Simmons, shortly after Dodd-Frank outlined the Home Valuation Code of Conduct that later became the Appraisal Independence Regulation. Michael Simmons came from your side as an originator. Kim Parati ran an appraisal company just north of San Francisco, and both with that regulation saw a need to create a model for appraiser accountability based on geographic competency and service. And this is translated now into licensing within 50 states, although we're domiciled in California. We continue our culture of identifying the best performing appraisers within a market, incenting them with good fees and response, allocation, but moreover a partnership and an advocacy position to help them grow and succeed. And along that vein, we've got two very special team members here to help out. I'll have Mark introduce himself in a minute, but Mark Kamyab is a unique individual and a unique partner. He's a longtime native of the appraiser industry in California and in Los Angeles. He's been appraising for more than 20 years. But moreover, Mark's a unique example of the best in class among a group of high performers. Mark embraces professional initiatives to mentor new appraisers, but moreover integrate them into a successful business model, which in turn serves our clients. He's communicative and knowledgeable, and as you'll see, he has a very deep understanding of local markets. Also on the panel is Tom Voss. He's our QC manager. Similarly, he has 2 decades in the appraisal. He's got interesting nationwide expertise. He served in municipal capacity in the assessor's office in Colorado. And for AXIS, he oversees a panel of our staff appraisers, in which we've got a small group throughout California that assist with high priority purchases, short-term refinances, even though we don't see much of those in this particular market. And he also heads our review team and an independent panel. So with the structure, I'm going to sit back on the JV desk and allow them to answer a set of questions that you've given to Mike in advance. Mark will give it a local perspective specific to the Los Angeles County area and surrounding markets. And Tom will be able to give a little bit of a higher perspective given his daily nationwide view among all of our clients across our 300 client set. So with that, Mark and Tom, I'll pass it over to you and let me know if I can help along the way.
All right. Well, I think thanks for that introduction, Mark. Great to be here, Mike. Thank you for the invitation. I will really just kind of turn it over to Mark. I think he's going to, as Mark Ayton said, Mark is going to be able to provide a very clear picture of your local Southern California markets. And so many times I will literally defer to him. And but maybe I can bring some enlightenment from, as Mark had said, in a big picture way. So with that, Mark, I'll turn it over to you.
Well, I appreciate it, Tom. Thanks, Mike, for having me. Mark, thank you for the introduction. Again, thank you all for joining us today for this hopefully informative hour. I'd like to cover some topics like that Mike had brought to our attention that you guys had let him know that you wanted more information about. So I'm happy to get right into it. Let's get into the topic of discussion: value versus worth. Okay. Super important to understand this. And there has been a shift over the last, like I would say, 9 months or so in this whole thing. But basically, value and worth aren't necessarily the same thing, and they don't always fall in line with each other. And there are many different types of value. There's market value, investment value, insurable value. But for mortgage transaction purposes and appraisals, we mainly focus on current market value. Okay. And an opinion of market value is fact-based. It's fact-based. It's evidence-based. It's based on comparable sales data, which are objective and inarguable. And you put those together in an appraisal report. You put those in front of an underwriter, to demonstrate and basically prove your case of why your opinion is credible. So as an appraiser, our job is to provide sales data, and sales data is, based on what's just occurred. More important than ever right now in a changing market, we look at sales data that are most recent. That's the most relevant. But there can be differences between the market value of a property and what a property is worth. And we know this for sure in the LA market. And I'll explain. What a property may be worth, okay, to a buyer may not represent its market value. And I'll give you an example. There were periods of time in the LA market where you had a buyer, they're ready to go, they find a house that they like, it's been on the market for 2 days, they put in an offer, even go slightly above asking, and what do you know? They lose out, right? You do this about 6 or 7 or 8 times, and that buyer starts to go, wait a minute, if I want to play ball here, I got to start offering way more above listing price just to even be considered. Okay. So at that point in time, the worth of that property isn't what that property is listed for, but what it's worth to that buyer is however much they're willing to pay above asking. Okay. So you may see a property listed for 1.5 million, and then, and I'm not talking about right now, but I'm talking about maybe, 6 to 9 months ago, you'd see a property listed for 1.5 million. All of a sudden it's in escrow. You see the pending purchase price at 1.9 million. And you're like, whoa, crazy. So needless to say, appraisers had a kind of a tough time keeping up, right? Because the worth of property values to potential buyers and borrowers was far exceeding what the sales data was providing for us to use as objective data to put in the appraisal report. Okay. So, like I said, we are limited by those sales. Just because there's 12 offers on a property doesn't mean that we can appraise it for that, because there's 12 other people willing to pay that price for that property. Really, what the bank wants to know is hey, on a worst case scenario, what's the value of this collateral, and what are we stuck with if we have to try to repossess this house, or we get this house back and we try to recoup the loan and minimize our loss? What's the worst case scenario? Not worst case scenario, but what's the most likely scenario, right? So that's where market value comes in, and that's where it can kind of deviate from worth. Does that make sense to everybody? Is there any questions on that?
So
okay.
Just real quick on that, Mark. So the same thing when the market's going crazy like that, you're having you do have sales data to support higher purchase prices when it's a falling market.
Oh yeah, absolutely. The reverse is very true. And we actually have a question very specific to that. So we'll get into that little bit later down the line. But, one of the things when we're talking about worth versus value is this, and I don't know if a lot of the audience here knows this, but for appraisal purposes, when we're doing an appraisal report for Fannie Mae or a conventional appraisal, we are capped by the highest sale price in that neighborhood, meaning we cannot appraise a property higher than the highest sale in that neighborhood. I don't know if many of you guys knew that. And again, it goes back to the reason is, like, if a highest sale in that neighborhood is $2 million and this one's in escrow for $2.4 million, right? How can an appraiser provide sales data at to support $2.4 million? We can't. That sales data doesn't exist, right? And then the next question I get asked whenever I say, hey, we're capped by the highest sale in that neighborhood, is, well, if that's the case, then how do property values ever go up? And the answer to that is pretty simple. We saw it happen over the last 2 years. Property values go up in an environment where the demand for housing exceeds the supply for housing. And so you get multiple offers on a property within a very short period of time. And typically an agent will pick an offer that's a stronger offer, maybe one with more cash down, maybe one without an appraisal contingency, maybe one that's willing to pay X amount over appraised value, not to exceed the purchase price. Okay. So once those types of offers are accepted, and once those sales close, those set the new cap or the new ceiling on what we're able to appraise in a given neighborhood. Does that make sense? Very good. Okay, so that was basically the little value versus worth in a nutshell and the differences between. One other slide I'd like to just cover real quick before we begin to the question.
Mark, just
Yeah.
real quick, we've got a question from Craig Peterson. So Craig, why don't you go ahead?
Hey, Mark, just back to the conversation you just had. Can't the quality of a home actually cause the appraised value to exceed what has sold in the past?
So that's a good question. Okay. What you're talking about is a property that is built to a higher quality of construction than its neighboring properties, right?
Yes. Improvements, upgrades.
Improvements. So we gotta walk a fine line there as appraisers, because on one end, the bank can argue, well, that home was over improved for that neighborhood, right? If you build this gorgeous, $10 million house in a neighborhood of $2 million houses, the bank could come back and say, hey, that's not represented at the market. Doesn't work that way. Now, let's forget that and say we're not doing it like that. But you have a very beautiful custom home built in a neighborhood where values range, right? Values range all over the place. Well, we have a baseline for our comparable search data, which generally starts at about half a mile radius in a normal stable market going back about 6 months, and a difference in gross living area of about 15 to 20%. Those are our baseline search criteria. What you're asking is, hey, you look in that half mile radius and you don't see another property that is similar in quality of construction, or maybe there aren't any new construction properties, right? The tear downs that have built, these modern farmhouse style houses that are popping up and stuff. There just aren't that many of those that have closed within that time period. An appraiser has the ability to expand the parameters for their comparable search if they can justify it. Okay. So if I have to go, instead of half mile, if I have to go a mile out to find the property that is more similar in quality of construction to the one I'm appraising or the one that you are selling, I can do so as long as I can provide the commentary and the reasoning behind why I did that. Does that answer your question, Greg?
It does. In more of a scenario where you have a tract of homes, or it's not custom homes, and the highest sale price, let's just take a 1.5 million, but there's very few upgrades, and then you have a model match that comes on market, but they've gone through, and these are older homes, gone through and they have remodeled the entire home. Maybe they've expanded a kitchen, or they do it. Just so what you're saying, I just want to confirm, is that there is some reasonable room for accommodation depending on, but I understand that you're saying every neighborhood's also going to have a cap.
Well, it's not that. Look, if you go into a competing neighborhood, okay, you can't jump from West Hollywood and go into the Beverly Hills to find your comp, right? Into the hills, right? But if you're going into a competing neighborhood and you can prove that, there's ways to prove it by, showing the median sales price in this neighborhood versus that neighborhood. We do have the latitude to expand the parameters to find a remodeled house that's been fully gutted down to the studs. Maybe they kept the wall up, like you said, or whatever it is the case. We do have the latitude to expand parameters with justification. If there are no other sales within a half mile radius, then we expand to 3/4 of a mile radius. If there are no sales within a 3/4 mile radius, then we expand to a mile radius. So that way, if the underwriter comes and goes, hey, there was 30 sales within a half mile, why did you go a mile out? Well, we go, well, we went a mile out because we had to find one property that was similar in upgrades and remodeling and updates to the one we are appraising.
Got it.
So that does give us the latitude to be able to do that.
Thanks, Mark.
You got it, Craig.
Mark, we've got one more question from Caroline.
Hi, my question is the same concept to like a house, let's say that's burned down, and then they've rebuilt, everything's completely rebuilt. And is it gonna be the same scenarios where you have maybe, I mean, I've been in Ventura neighborhoods that one burned, the other one didn't, the other way, and it's like so different. How do you guys appraise scenarios like that? Because now that rebuild added things they always would want to do, and they had the opportunity now to do it. So how does that all
Play out.
play out?
Well, Tom, do you want to jump in any of this? I'm happy to keep going, but I mean, basically our job, and there's one concept here that I'd like to mention. I don't have a slide for it. I do talk about it sometimes in presentations, but it's the concept of bracketing. And bracketing means when you're putting together your sales data in an appraisal report, you need to bracket the different amenities or attributes of that property. Okay, so if I'm appraising a property, let's say that has an amazing outdoor kitchen and a pool and spa, right? I can't use all comps without amenities and just make upward adjustments for every comp. We must be able to bracket those amenities. And again, that goes back to giving us the latitude to expand parameters until we find a comp that does. Does that make sense?
Yeah. And just from a lending perspective, we don't want, Caroline, if you have like this beautiful brand new property that's in this neighborhood that's 60, 70 years old, and it's like a unicorn in that particular neighborhood, then we're lending on that. We have to look at that as well to kind of see, like, do we want to lend full, like do a 5% down, type of a loan on that type of a property in an area where it's overbuilt.
Got it. Thank you for that.
I think the only thing I would add to that is that one of the things that, especially in the scenario of maybe a well-improved home or a home that's been destroyed and rebuilt, one of the things that we really do need to do is demonstrate the market reaction to that. And we can do that in various ways. And as Mark had said, we'll look for homes with similar attributes, maybe homes in other neighborhoods that have been destroyed and rebuilt and sold. That's kind of important because we know that the market is not adverse to purchasing a home that has been destroyed and rebuilt. So that is kind of an important concept, along with, it's that old adage, what's the most important thing in real estate is location, location, location. So we do need to stay proximate for some of our comparables to demonstrate the market in that location, but we also may need to find attributes in other locations that match the attributes of the subject not matched in its current location.
Well said.
I wanted to add just one more component to that answer. I live in a neighborhood in northern Sonoma County that was almost completely leveled by fire in the 2017, 2018 events up here. And to elaborate a little bit on the opportunities that creates is that our home was lucky enough to have survived, and yet the home across the street was completely leveled. The home 2 doors down was completely leveled. And as those occupants received insurance funds and rebuilt over that year, they were rebuilt to current standards, current amenities, and of course the quality really brought up the opportunity, the value for the rest of our neighborhood. But during that process in which there were not active sales taking place, what really helped a lot was communication between realtor peers in other neighborhoods that would have similar demand by similar buyers. And as Mark and Tom have both touched on, that communication and being able to create a credible justification to a lender that a typical buyer in my neighborhood is also the same buyer that is buying in another neighborhood. Being able to pull those comps in was really helpful to some of us that were also trying to improve and harden our houses through refinances through that time. So, and I'm sure you're living through a similar real life scenario in your neighborhoods with the recent fires down there, Carolyn. So I'm sure you'll see some of the same things. Thank you, Mark.
Thank you. And just one last question. I've had where sellers will say, well, I have receipts of this is what I did, or, and they'll want to provide that. And then us go, can we send you some information before you go, just to take into account? How do those receipts, or how does that information even play in on your process?
Well, Tom, do you want to speak on it, or would you like me to? You want to speak on it?
A lot of times when I was appraising in the field, and I certainly will defer to Mark and his practice, but believe it or not, a home speaks very well for itself without receipts,
Yes.
without a lot of narrative from the homeowner.
Yeah.
Just by observing. We have all been into homes that some things we like, some things we don't like. We don't need to know the cost of those things to appreciate them more. We can look at them and go, we may have questions as realtors as appraisers as we're doing our inspection. And we may inquire and get more, clarification about certain features that may appear to be more custom or more recent or whatever. But homes speak very well for themselves for the most part.
And here's what I'd add to that. Carolyn, it never hurts to provide a list of upgrades to an appraiser, ever. Okay. It's always useful. However, like Tom mentioned, it's kind of funny. I actually used this analogy yesterday when I was appraising a multifamily property right around Carthay Circle. I walked in the house and I was like, okay, is the laundry room here? And he goes, yeah, it is. It's right behind the door. How did you know? And I go, after doing this for so long, it's funny. You walk into a house and it's almost like the movie The Matrix. We're able to see things that, you're like, oh, that was an addition. That was this, that was that. So what Tom mentioned goes back to, our ability to be able to recognize these features without much commentary or insight from the seller or the person maybe refinancing their home. We're able to see it. Now, on a dollar for dollar basis, which I think your question was kind of more pointed towards, like, hey, here's the receipt. I spent, $5,400 on this. So does that increase my property value by $5,400? And the answer to that is pretty simple. It's no, it doesn't. Okay. It increases your property value as much as the market is willing to accept it. Okay. So you might spend $75,000 on a pool. Okay. On a gorgeous, beautiful pool. But you compare two homes in that neighborhood, right? One with a pool and one without a pool. And I'm talking about an ideal world. And this is one way we derive our adjustments, right? We're not just making them up and pulling them out of thin air. You have two identical houses. One has a pool, one doesn't have a pool. The one with the pool sold for $25,000 more, right? So you'll see a $25,000 adjustment in there for the pool. And maybe the homeowner or the seller go, wait a minute, I spent $78,000 for this. Well, yes, you spent $78,000 to put that pool in. However, the market's reaction to a home in that neighborhood having a pool is only $25,000. Does that make sense?
It kind of goes back to the value.
Yes, it does. Thank you.
Yes.
Yeah, makes total sense. Thank you for that.
All right. Are we ready for the next slide?
Yeah, let's move on.
All right, cool. I'm going to not spend too much time on this, but I just think it's just super important to cover. And I call this slide the fallacy of the price per square foot. Not all agents, but some agents price homes based on price per square foot. Okay. And they'll go, hey, this home sold for this price. It had this much square footage. So that's what I've used to base the price of this home on. Okay. That's fine and everything, but just for lending purpose and appraisal purposes, appraisers almost never rely on price per square foot. And I'll explain why. Why do we not rely on price per square foot? Well, price per square foot only focuses on two factors. Okay. What was the sales price of that home? And what was the living area of the dwelling? Like, what was the gross square footage of the dwelling? 2,000 square feet? Cool. and you're taking the sales price, dividing it by the other, and you're coming up with a cost per square foot. Okay. That doesn't give you a full picture of what's going on with that property. Okay. Price per square foot does not take into consideration all the other variables that an appraiser must consider, like amenities such as a pool, the location, the view of that home, the condition of the home, own solar panels. Does it have an accessory unit? How big's the lot size? These types of things are not even touched on in a price per square foot kind of way of looking at or pricing a property. So when developing an opinion of market value, an appraiser must consider and give weight to all these things, and not just, hey, what was the square footage of the dwelling of that property and what did it sell for? Does that make sense? So that's why price per square foot, when we're presented like with a, hey, why didn't you use this? The price per square foot is this. That's the reasoning. That really is what it's all about. All right. If there's no questions, we'll pop down the next slide, and I'll let Tom take the lead on this.
Yeah, so let me just get a clear picture here. Yeah, as we go through this period of inflation, what are prices doing? Prices are still determined really for the most part by supply and demand. And it's entirely possible that even through inflation, we could see prices continue to go up in areas where demand is greater than the supply of homes. Does inflation affect that? Absolutely. But it really, if somebody needs, is in a position where they want to live in an area, or they need to move to an area that has a low inventory, then that's going to maintain price levels. Mark, do you have any thoughts on that?
And yeah, I'll just add to this. We are going through this this period of time. It's, we went through this amazing run during COVID with ultra low interest rates, right? And massive amount of volume of transactions happening. And now we're seeing the pendulum kind of swing, because the Fed's going, uh-oh, maybe we did too much, or we were too lax for too long, or whatever. And now they're hitting the brakes, and they're hiking these interest, the Fed rate, as Mike mentioned. And what that's happening is, and what that indirectly happens in this fight against inflation is, when the Fed hikes interest rates, I'm not sure if everyone is aware, but that doesn't directly correlate with mortgage rates going up. So just because the Fed rate went up 0.75% doesn't mean mortgage rates tomorrow are going to be 0.75% higher. Okay. The mortgage rates tend to follow the 10-year bond. The 10-year bond treasuries. This essentially a 10-year bond or a treasury is kind of like you're basically giving a loan to the government for a guaranteed return on investment, right? So when they announce these policies impact the way investors in equities and other types of instruments, right, react to these moves that the Fed is making. And so when the 10-year bond goes up, right, so do mortgage interest rates. When the 10-year bond yield goes down, meaning, hey, if I buy a 10-year bond and leave my money in there, I'm only going to get back a 1.5% every year. It's not very favorable. That tends to bring interest rates down. Is that right, Mike? Maybe you can speak on that a little bit as well.
No, that's correct. I mean, basically, the Fed is there to stable employment and price stability. And so the fact right now, the market is telling the Fed, like, they don't have any confidence in what the Fed is doing to control inflation. And so that's why the mortgage rates are going up, and the bond market the yield is driving up there. And so that's the demand for properties is going down as a result of the higher interest rates.
That's right. And, so when you say, how does this period of inflation going to impact values? it's going to not, inflation isn't going to directly impact values. It's going to indirectly impact values in the sense that the Fed's fight against inflation is going to require their stance and their how aggressive they need to be to bring inflation down, right? The more aggressive they are to try to bring inflation down, the higher their Fed rate. And it tends not directly, but indirectly to impact the 10-year bond, which pushes mortgage interest rates up. Okay, so if they continue on this very hawkish tone and aggressive rate hikes, it will impact mortgage interest rates. And as mortgage interest rates go up, buying power comes down. So when you could, at 3%, you may have been able to afford a $1.5 million house. At 6%, you may only be able to afford a $900,000 house. Okay, so when buying power comes down, even though there's an incredible demand for housing, people want housing. Rent prices are soaring, right? It's still, people are still kind of crippled or handicapped by their buying power and what the interest rates have done to that. So during this period of inflation with interest rates up, if a seller really wants to sell or needs to sell, okay, they may need to lower their expectations because the pool of buyers are able to afford that property have now shrunk. Does that make sense? And so that's how inflation, I believe, indirectly impacts values. But again, as Tom pointed out, it can also it doesn't always correlate exactly like that. There's still a massive demand for housing. There's still a housing shortage. None of those fundamentals have changed. So depending on the price point of the property, it could go one way or the other. Okay, next question. I'll read the question and I'll let Tom take the lead on this. We have been seeing appraisals come back over the purchase price. Is this going to continue?
In some markets, again, because I do see the big picture, I think in some markets this will continue. As Mark had said earlier, appraisers look back historically. So until the sales available for us for comparison begin to reflect this market, if older data is required, I think that in that looking back portion, we are going to see some appraisals continue to come in above the purchase price. And we even saw that before. We started having some of this slowdown in the real estate market. But oftentimes, we really are looking more historically at what is sold instead of right now. So there will be a period of time that we'll probably continue to see some appraisals above the contract price.
Yeah, and I just like to add to this. The reason we're seeing appraisals come back over purchase price is because that's not the challenge for us now. Okay, we have the sales, or up until very recently, we are able to go back, typically in traditional appraisal practice up to 6 months, and that's reasonable, right? In a transitioning market, like I said, underwriters like to see more recent sales. However, those sales of up to 6 months ago are still valid, and you can still use them with justification. So there was actually a period of time, where I couldn't appraise a property. The appraisal of the property couldn't even come in at purchase price. I had to come above the purchase price because the realtor or whatever, the contract price was lower than the lowest sale in the neighborhood. And just like I said about capping on the higher end, like we can't appraise a property higher than the highest sale, we also can't appraise a property lower than the lowest sale. So Tom's saying, sales data and comparable sales data is looking back in time. We're looking back in history. Okay. Once those, and we still have plenty of sales that support purchase price, and that's coming in. That's not our biggest challenge right now in terms of appraisals. Okay. What our biggest challenge is lots of lenders continue and underwriters would like us to include in an appraisal report, not just a minimum of 3 closed sales, but they also want us to include a couple pending and active listings. Okay. So it's not finding the sales that support the purchase price. You find those all day long now, if the property is priced realistically, and in most 95, 98% of cases, they are these days. The challenge is you appraise a property and you have 20 comps to support $1.4 million. And you look for your listings. You're like, oh, wait, my highest listing is 1.375. And then it drops down to 1.35. And then I got, wait, you see? And so what we find ourselves doing right now is scrambling to see, hey, are those properties that are in escrow right now, have those, it's the status has been updated to under contract or pending, but are they in under contract or pending above asking, right? So that's where, as realtors, you might be getting more calls right now from appraisers going, hey, just curious, are you able to let me know if this property that you have under contract is going above asking? And if you're able to disclose, what is that price? It's not for any other reason than we're trying to put together an appraisal report that makes sense. And we are trying to represent the market as accurately as possible, okay? Because when you start to see that trend, okay, an underwriter is going to look at that appraisal report and go, oh, sales in June and July and August were good, but the listings now are all below that. So is this a declining market? You see, and as soon as you start getting into that conversation, the scrutiny under which these loans come increases exponentially. And Mike, you can probably attest to that, right?
Yes, absolutely. We can attest to that. So it is tough in a falling market to kind of make sure that we're lending on an appropriate value.
Yeah. So one of the things I ask, if there's any agents or realtors, in the audience, is a couple things. When pricing a home, if the property doesn't sell within a couple of weeks, it's okay. It's like, 15 to 60 days is a very healthy, normal exposure time. So don't be panicked if it doesn't go or you don't get any bites in a couple of weeks. If, 20 days, 25 days goes by, okay, you're kind of, priced yourself out a little bit. But to see like multiple price, reductions within a couple of weeks, to me, undermines that listing. It kind of stigmatizes it a bit. And then also, in my opinion, the best way to price right now is look at what's sold in the last 30 days and price based on that, or as close to that as possible, and see if you can get people to bite. The last thing I'll say to that, to help appraisers out and to help yourselves out to get these appraisals and these loans completed, is if you are able to disclose contingencies have been waived and it's okay to update the MLS listing with the actual pending price of that property, it would be greatly appreciated if you could do so, because that would save us a phone call and the playing of the phone tag and all that kind of stuff, right? Because if you have a property listed at 1.35, but it's in escrow for 1.4, that just saved me, right, from having to explain to the underwriter, wait, it's not a declining market yet, right? Because here's a listing that's actually an escrow for 1.4. Make sense? With that, I believe we could.
Could I say, just add a little bit more to that, and to just illustrate Mark's point, is appraisals work under the law of substitution. So the question really does become for an underwriter is, why would I pay 1.4 for the subject when I can get a very similar or same home right now for 1.35 or something like that? And that's, for an appraiser, that can be a very challenging question to answer if we don't have the proper support just to meet a contract price. So that law of substitution is very critical, because and as realtors, that really should be a part of your discussion or your thought process in valuing, your listing, is if I can get this home for 1.35, why do I believe that my home that I'm listing is worth 1.4? What makes it better than that one?
Yeah, very good. Jump on to the next one. We have buyers and borrowers that are waiting for the market to drop like 2008. Is that going to happen, Tom?
You know, it's really two entirely different scenarios. Part of what drove the meltdown was, you know, before were borrowers being mortgages that they should not have been in. And that literally flooded the market with foreclosures. Right now, as we've said, in many parts of the country right now, there is still an undersupply of homes. So unless and until we see, we see foreclosures dramatically going up, we don't even have the same scenario.
You
Yeah.
know, and
Go ahead, Mark.
sorry, Mark, would you like to say something, add something, Mark?
No, I was just going to add as an economics grad, the parameters that set up 2008 to accelerate the decline so quickly have largely been regulated and monitored out of the market. The lack of transparency in mortgage-backed security values and the underlying collateral has been largely eliminated. That doesn't mean that the market isn't going to necessarily see a correction or a swing, and I think we're in the beginnings of that, at least as far as we can tell in the next year. Whether or not we'll see huge drops in purchase prices and offerings of values, I think remains to be seen. Again, we keep on going back to the fact that in a rational economic market, supply and demand are always the driving factors, and we certainly are weighted heavily on the demand and short on the supply side right now. There are many other things that can happen. The GSEs are playing with waivers, with expanding eligibility for borrowers in various ways, reducing down payment costs. So we may see some effects on that as well. Mark, I don't want to step on you. Please take it.
Oh, it's not at all. Thank you for that insight. What I was going to say is just kind of echoing what Mark and Tom were saying is, look, 2008 was completely a different scenario. 2008 meltdown was based on mortgage toxic debt built on subprime lending to borrowers that in no way should have ever qualified for that loan. Okay, I'll give you an example. Not that I ever missed payments or defaulted or foreclosed on my property, but I think I was like 25 years old when I bought my first house in Miracle Mile. I bought it for $1.1 million with 0% down, okay, on stated income. Means I had to provide no paperwork to the bank. I just basically told them, hey, I make this much money. They said, cool. And they gave me a loan for the full amount, okay? Now, me being an appraiser, I didn't get kind of caught by that because I kind of saw stuff coming down the line in 2007 and I was out. But that's what caused 2008. It was people getting loans that in no way, were qualified for those loans. So the market bottom fell out. What's happening now is not that. Okay, the fundamentals of the mortgage industry have been heavily regulated. They are very solid. These loans that are currently out there now have been vetted very strongly. So right now, it's not mortgage toxic debt that's causing what's happening. It's the fight against inflation, and that's the difference. Okay.
All right, next.
Are investors having an impact on values? Are they still buying, Tom?
I think the easy answer to that is yes. Yes and yes. I think at this time, we're probably seeing more investors, and I'm going to kind of clarify that, non-owner occupied investors. Almost anybody that you might talk to knows somebody who owns an Airbnb, it seems like. And those investors are driving a couple of things. They really are impacting the inventory available for owner occupants, and they create a larger buyer pool, especially for those homes that may be a lot of times for the market entrant. if you will. And so although an investor buyer could be really at any tier of the, of the buying spectrum, but they have the ability and oftentimes can react faster to listings and other properties faster than a typical owner occupant buyer. So I think, yes, absolutely.
Yeah, and I'd like to add a little bit to that as well. So to me, the days of flip this house and flip or flop kind of buying as investors, that's on pause right now. Okay, not ideal to buy a property and think you're going to be able to flip it and make it massive profit right now. That type of investing has slowed down, in my opinion, dramatically. Now, are investors, and I'm talking serious investors, still buying, and are they still having an impact on value? Absolutely. These serious buyers tend to be higher net worth individuals, okay, that have, financial advisors that have been through the cycle before. They know what's coming down the pipe, and they've actually prepared themselves for this very scenario. So they're finding themselves in an environment now where they have more leverage to negotiate, ask for concessions, and not have to compete against multiple offers. Okay, so are they still buying? They are still buying. They're looking for those. Properties that where they feel like, hey, they're getting them at a steal, that they're underpriced, or for whatever reason that property was stigmatized. Whether it was the listings, that you can stigmatize a property by listing it way too high to begin with. And I say this all the time too. It's like you list a property way too high to begin with, and it could be based on seller price pressure or seller pricing, seller saying, hey, my property is worth this. You list that high, and then you have to reduce the price and reduce the price. Well, the longer that property sits on the market and the more price reductions, right? People are going to start looking at that listing and go, that property's been there for about 75 days. No one's buying it. What's wrong with it? Okay, so that stigmatizes the property. And so that can actually impact the property negatively, in the sense that had it been priced properly to begin with, it probably would have sold for more than what it'll end up selling for after sitting on the market for longer than typical exposure time right now. Okay.
I'll add one more component to that, just from the perspective of our 350 client set, of which we do have private money investors. We do have some small and medium-sized REITs that are still around doing this. The investor pool of money gives them, as Mark and Tom both mentioned, a lot of flexibility, and I differentiate those from the individual non-owner occupants that Tom highlighted earlier. One thing that we have seen, though, is that while mortgage rates may not be directly related to the Fed increases we've seen, certainly those investor lines of credit that they use for those pools are. And as those expenses have gone up and that available pool has shrunk a little bit, their proportion of the purchase market we've seen has begun to drop. One of the really surprising statistics that we've tracked is that in Q2 of this year, in some markets, including the Los Angeles area, investors of various types represented almost a third of the overall market velocity and transaction and turnover, and that's been vastly reduced over this quarter. That, of course, means larger opportunities for the smaller individual non-owner occupants that Tom was mentioning, and I think that those will be a valuable pool of potential buyers in the coming months.
Very good.
We've got about 7 more minutes, guys. So we got to kind of hustle up on the last couple of slides here.
Sure. Days in the market. Have you seen this go up, Tom?
Yeah, and that's okay.
Yeah,
It's definitely not alarming. I think it's a good sign in many ways. I think it gives more people a chance to participate in purchasing a home.
Perfect.
I agree. I don't have anything more to say to that other than it's healthy for a property to be on the market in my opinion, 15 to 60 days is a healthy exposure time, and for
2 days on market is not realistic. And
yeah.
And this is, I mean, the reality is whatever interest rates may be, we've been there before. And homes sold and people bought and life goes on.
All right.
Are we going to start seeing negative time adjustments in appraisal reports? I can take this real quick if you don't mind, Tom,
Go
just so we
ahead.
can
Yeah.
get through it. Are we going to start to see negative time adjustments in appraisal reports? Well, hopefully not. But there is likely going to be a correction due to these interest rate hikes. You talked to me a month ago, I would have said probably a 10% correction. Now, who knows, right? I don't know where these interest rates will stop. Negative time adjustments in appraisal reports are only necessary if you're using dated comps. Okay. If you're using comps within the last 45 days, there's no real reason to use a negative time adjustment. There hasn't been enough time that has passed to justify a time adjustment, right? Unless the market is decelerating at a very, very fast pace, right? Right, Tom? Is that why you're laughing?
Yep, that's it. Yeah. If those sales just can't keep up with the decrease, or even, I mean, 2 years ago, an increase, it just, more recent sales are always the better sales to use.
Now, if the market dramatically slows down and we have like 6 sales within the last 6 months, and 2 of the most relevant are from 4 or 5 months ago, and the market has been declining, are you going to see negative time adjustments? Probably. Okay. That's just same as you saw with positive time adjustments. Suburbs versus the city, are the changes the same or are they different? Tom?
They're 2 entirely different buyer pools, in my opinion. Somebody who wants to live in the suburb is not going to live in a rural, in an urban setting, just like a lot of people who live in an urban setting don't want to live in the suburbs. So it's 2 really different markets, but they're both affected by all the same things: inventory, interest rates, all of those things.
100%. I agree. I concur. I think we can move on. It's just 2 different sets of buyers, right? People moving out in the suburbs tend to be more families, especially in the LA area. People tend to be living in the more urban, more high density areas, tend to be either single married, not planning to have kids and that sort of thing. And that's okay. People moving to Studio City, Sherman Oaks, Tarzana, all those places tend to have kids looking for decent schools where they don't have to pay $40,000 a year. Okay. Seller concessions, how do they affect value? Tom?
Fannie Mae is pretty clear. If a concession affects the purchase price, then it needs to be adjusted for within the appraisal. And an example of that would be if a home is listed at 200,000 and it sells for 200,000 with $5,000 in concession, there was no influence in that $5,000 to the purchase. However, if the home is listed at $200,000 and there's $5,000 in concessions and it sold for $205,000, that $5,000 concession literally affected that purchase price, and that absolutely will be adjusted for.
100%. Makes sense to everybody? Okay, cool. Sound good. Now, I'm going to get into one of our final slides here before we have maybe a minute or 2 for a Q&A. Here's the thing. Nobody likes to enter re-inspection. Nobody likes to have to explain to their, client, hey, the appraiser's got to go back out there and you got to pay X amount for them to do so because the property didn't have this or that and the other. And usually there's some simple things. So I've just put together a list of things that you can double check prior to the appraisal inspection to avoid a re-inspection for conventional appraisals. And I talk about conventional appraisals because that's mostly what we're dealing with in the LA County area. We're really priced out kind of the FHA type of loans in most markets. Okay. So things to double check prior to inspection: water heater, is it double strapped? Okay. That's California state code. Okay. A lot of lenders and underwriters ask us to comment on that. If it's not double strapped, they ask us to go back out there and ensure that it is. Okay. Carbon monoxide and smoke detectors installed. Very easy to check. I always tell agents, hey, you know, buy a pack of them from Costco, throw them in your trunk, you know, and when you go to the property, if it doesn't have a carbon monoxide detector, plug it in the wall. You know, very easy to do to try to avoid the reinspection. Some, but not all lenders ask us to comment on if a property is vacant, ask us to comment whether utilities are on. And the reason they do so is they want us to ensure that the actual utilities work, right? So if the property is vacant, just double check, hey, when I turn on the stove, does the burners come on, does the lights come on, you know, is there water running, that sort of thing. For new construction, when there is one and the appraisal has been actually, this is to avoid a reinspection. So for a new construction, if you don't want a reinspection, make sure that the home is completed per the plans and specifications outlined in the original plans before you ask for the appraiser to come out to the property. Like if they come out to the property and everything's cool, but then the gas meter isn't installed or the appliances aren't in, and that was part of the purchase, then we'd be required to come back to ensure and sign off that those things are in place. Okay, last thing, very relevant to the LA market. I just dealt with it yesterday. Fortunately, they had safety release latches. If a property has security bars on even one window of a home and the underwriter sees it, they want to know and commentary about the bedroom windows of that property and whether those bedrooms or bedroom windows or doors, whether those bedrooms have a secondary form of exit in case of emergency. That's California law. Each room considered sleeping quarters is required to have a secondary form of egress for safety purposes. Doesn't mean you can't have security bars on those windows. Just means at least one window in each bedroom needs to have security bars with a safety release latch. Those can be the ones that you step down on and they pop open, or they can be the ones that you kind of twist like this and they pop open. So that's a requirement. Or one bedroom in each window can be without security bars, right? So if the security bars are permanently affixed, okay, prior to the appraisal, you can have a handyman come out, unscrew those security bars and remove the security bars from one window from each bedroom, and then you will fulfill that requirement, and that appraisal report will not be subject to reinspection or removal of those security bars. Make sense?
Mhm.
Cool. Well, I don't know if we have time for Q&A because I feel like we're probably towards the end, but Mike, I'll let you take it from here.
Yeah, let's go ahead. Caroline's got a question.
A very fast one. Does a smoke detector have to be in every single room? I get mixed on this.
Yes. So here's the thing. In every single room, no. In every single bedroom, yes. And the hallway outside the bedroom, yes. And one in the common area, yes. Okay. But not in you don't have to have one in the dining room, one in the kitchen, one in the living room, no, just one in the common areas, one outside the sleeping quarters, one in each bedroom. Now, if you have a split wing home where you have the master on one side and you have, the other 3 bedrooms on the other side, you'll need a smoke detector outside the the master, the hallway outside the master, and smoke detector and carbon monoxide detector for both outside on each side of the house. Does that make sense? Cool.
Thank you.
You got it.
All right. Any other questions from anybody?
Yes, I'm holding this one right
Perfect.
now. You ready?
Well, guys, I appreciate Tom, Mark, and Mark putting this together and going over everything with us. And hopefully we'll see values stabilize. Hopefully we'll see interest rates come down here shortly, and we'll get the engine flowing again here and start pedaling and getting the inventory moving a little bit faster here. So thank you guys for all your time, and appreciate it. If you have any other questions for me, feel free to email me, and I would love to answer any of those questions. So thanks, guys.
Thank you, Michael. Appreciate the opportunity.
Thank you
We'll
for
be
having
listening to your podcast to keep
All
up to
right.
date.
Thank
Take care.
you.
Thank
Bye-bye.
you everyone for joining us. Appreciate it.